Streamline lending in 2025 is basically this whole ecosystem of digital platforms that facilitate borrowing without the need for physical branches. It's evolved dramatically over the past decade. Biggest players now fall into a few categories. You've got the digital first lenders like SoFi and Lending Club, who've built their entire operation around the streamlined digital application experience. Then there are marketplace platforms that basically connect borrowers with various lending options.
Kind of like what we do here at businessloans.com, but we specialize in business lending specifically.
Exactly. And now we're seeing a huge shift towards AI-powered underwriting systems that can evaluate credit worthiness using alternative data points beyond just FICO scores. That's been a game changer, especially for underserved markets.
It's wild how much data these systems can process now. Like they can look at cash flow patterns, business performance metrics, even things like supplier relationships that traditional banks weren't considered 5 years ago.
Totally. And embedded finance is probably the fastest growing segment, where lending options are directly integrated into businesses' software and services. Think about getting financing options right inside your accounting software or payment processing systems. The rise of banking as serve APIs has made that possible.
I've seen some pretty crazy stats on that. Wasn't that like 40% growth year over year for embedded finance solutions?
Close. Last report I saw had a 38% CAGR through 2024, but it's likely accelerated since then.
So let's talk about the SBA modernization specifically. I read this Forbes article today by Doug Crisatello that talks about how the COVID pandemic basically forced the SBA to upgrade all their systems. What's your take on that?
It's fascinating, right? Talk about necessity driving innovation. The PPP program was this massive stress test for the SBA. They went from handling about 55,000 loans annually to processing over 12 million loans in just 18 months. Their systems were never built for that kind of volume.
That's a 218 times increase in volume. Insane.
Exactly. They have had no choice but to modernize. They basically had to implement what would have been 5-year tech upgrade plan in a matter of months. They moved to cloud-based solutions, streamlined application processing, and completely revamped their customer service systems.
I remember hearing how clunky the SBA systems were pre-COVID, like literally fax machines and paper forms were still part of the process for some programs.
Oh God, the fax machines. That's all changed now. The article mentions how they've embraced cloud solutions and are even exploring AI and machine learning tools. The really interesting part is how they expanded their lender network from about 1,500 to over 5,000 during the pandemic.
That's huge for access. So many businesses, especially in underserved communities, don't have relationships with SBA lenders.
And it showed the SBA that they could significantly expand their reach by lowering barriers to entry for lenders, simplifying regulations, and clarifying program rules.
But I also saw some concerning news today. Did you see the Barron's article about SBA loans going bad?
The article is making its rounds in fintech circles today. According to their reporting, delinquencies and defaults have increased significantly in the 7A loan programs, which is the SBA's flagship lending program.
What's driving that increase? Is it just the economy and interest rates?
That's part of it. The article cited an internal SBA risk analysis that mentioned the Fed's 2002 rates hikes affected variable rate loan performance across the board. The SBA loans performed even worse than other types of bank loans. Early defaults within the first 18 months tripled from 2022 to over 1% in 2024.
That's significant. I wonder if it's connected to some of the modernization efforts we were just discussing. Sometimes when you expand access quickly, risk management can suffer.
Yeah, the article specifically mentioned that there's a tension between expanding access and maintaining loan quality. Senator Ernest was quoted blaming the Biden administration for cutting fees while loosening lending standards. Apparently, they made it so banks could lend up to $1 million under the program without paying a fee for government guarantee.
Wait, that seems like a weird incentive structure. If lenders don't have to pay for the guarantee, doesn't that potentially encourage riskier lending since they're protected?
That's exactly the criticism. Fee revenue dropped more than $100 million year over year, while defaulted loans they had to purchase ballooned from $570 million to fiscal 2021 to $1.6 billion in 2024. The program went from being self-funding to having negative cash flow of around $370 million.
Yikes, that's not sustainable. But I'm torn because expanding access is so important. I see businesses that come through our platform, and many of them really need these programs.
That's the fundamental challenge. How do you balance access with responsible lending? The article also pointed to another factor, the administration of fintech lenders to the 7A program.
This is right in our arena. What's your take on fintechs entering this space?
I think fintechs can absolutely bring innovation to SBA lending. The application process can be more streamlined, the user experience better, and they can often reach businesses that traditional banks aren't serving.
But there are risks too, right? I mean, during PPP, some fintech lenders had much higher fraud rates than traditional banks.
That's true. Senator Ernest specifically mentioned that in the hearing covered by Barron's. The PPP experience showed that some fintechs didn't have adequate fraud controls in place. But I'd argue that's not inherent to fintechs. It's about having the right risk management systems, which both banks and fintechs need.
I actually think that's why our approach at businessloans.com works so well. We're leveraging technology to improve matching and efficiency, but we're working with established lenders who have experience managing risk.
Exactly. In my role working with our lending partners, I see both sides of it. We get the benefits of our technology platform while lenders bring their risk management experience. While lenders bring their risk management expertise. Our lender onboarding process is pretty rigorous too. We're selective about who we partner with because we want quality outcomes for businesses, not just quantity of applications.
So where do you see all of this going? What's the future of SBA lending and online small business lending more broadly?
I think we're at an inflection point. The SBA has these enhanced technological capabilities now, but they need to find the right balance between expansion and risk management. The Forbes article mentioned a few interesting possibilities of how the SBA might evolve.
Like what?
3 main paths. First, better targeting the credit assistance to align with policy priorities like rebuilding U.S. manufacturing. Second, stimulating the use of new financial technologies like the securitization of unguaranteed loan portions they approved in June 2024. And third, sharing the modernized services with our other lending agencies to reduce costs across federal government.
I'm particularly interested in the securitization aspect. That could really increase liquidity in the small business lending market.
Absolutely. It's the first of its kind multi-party securitization of the unguaranteed portions of loans. That gives investors a chance to see how these pooled loans perform without federal banking, which could lead to more securitizations of business loans generally. More liquidity means more lending capacity.
So despite the challenges, you're optimistic about the direction of small business lending.
Cautiously optimistic. The technology and capacity are there. The demand is certainly there. We just need to get the incentives and risk management right.
Let's talk about AI for a minute, since that's been such a hot topic. How is AI changing the lending landscape for small businesses?
It's transformative in a few ways. First, it's making underwriting much more sophisticated. Instead of just looking at credit scores and financial statements, AI systems can analyze thousands of data points and build a more comprehensive risk profile.
I've heard some lenders are even looking at things like social media presence, online reviews, and like website traffic patterns now. Is that widespread?
It's definitely happening, but with mixed results. Some alternative data points have proven predictive, while others are still experimental. The key is having enough historical data to validate that these new data points actually correlate with repayment behavior.
I like how we're exploring how we can use AI to better match businesses with the right lenders, but we're careful about what data we use and how we use it.
Yeah, there are real ethical considerations and potential biases to be aware of. The most responsible implementations use AI as a supplement to human judgment, not a replacement.
The Forbes article mentioned AI tools helping with outreach, program integrity, and processing speed. It seems like the SBA is thinking along similar lines.
Yes, and that's promising. The government tends to lag the private sector in tech adoption. So seeing the SBA embrace these tools suggests they're really committed to modernization.
Switching gears slightly, what are the biggest challenges you're seeing for small businesses seeking financing right now?
The interest rate environment remains challenging, though things have stabilized somewhat. Many businesses took out loans during the low rate environment in 2020 to 2021, and now they're facing much higher costs to refinance or get funding.
We definitely see that on our platform.
Totally, and I'm constantly updating our lender profiles in the system as their requirements shift with the market. Beyond rates, I'd say the biggest challenge is still the mismatch between lender requirements and business profiles. Despite all the tech advances, many businesses still waste time applying with lenders that aren't right for them. them.
That's exactly the problem we're trying to solve. Nothing is more frustrating than going through a lengthy application process only to get declined.
And each decline can impact your credit score, making the next application even harder. It's a negative feedback loop.
We found that pre-qualifying businesses based on lender criteria can increase approval rates by over 70%. It's all about getting the right businesses in front of the right lender.
That's the value proposition for platforms like yours. The ecosystem needs those systems in place that can efficiently match supply and demand.
This has been such an insightful conversation, Jordyn. As we wrap up, any final thoughts on what business owners should be doing or thinking about in this environment?
I'd say 3 things. First, do your homework before applying for financing. Understand what different lenders are looking for and focus your efforts on those who match your profile. Second, explore multiple financing options. Traditional term loans aren't always the best solution. Depending on your business, things like revenue-based financing, equipment financing, or lines of credit might be more appropriate. Third, keep an eye on your cash flow. Way higher interest rates, the cost of your capital is more significant, so you need to be sure you're deploying the capital in ways that generate sufficient returns.
That's great advice. And for our viewers, if you're looking for business financing, definitely check out businessloans.com. We can help match you with lenders that fit your specific situation, all while keeping the process simple and straightforward. What topics should we cover in our next conversation?
I'd love to dive deeper into specific financing options for different types of businesses. Maybe we could focus on startups on one episode, seasonal businesses on another, and so on.
I love that idea. We could also explore industry-specific finance challenges and solutions like healthcare, construction, or even e-commerce.
Absolutely. Each industry has its own unique financing needs and challenges.
Well, that's all the time we have for today. Thanks so much for joining us, Jordyn, and sharing your expertise on online lending and SBA modernization.
It was my pleasure, Sureena. Thanks for having me.
Thank you all for watching. As always, if you're looking to connect with lenders and match your business profile, check us out at businessloans.com. If you found this conversation helpful, please like and subscribe and drop any questions or topic suggestions in the comments below. Until next time.
See you next time. And remember, feel free to reach out if you have any specific questions about business financing. We have a whole team ready to help.